Dear friends, good afternoon. I'm very happy to welcome you to our webinar. I'm Dimitris Kostaras, the Head of Investment Advice, and together with Kirill Kovalenko and Dimitris Theophanides, our experienced private wealth managers, will discuss about what an investor can expect during a bad market environment. It's true that 2022 remains a year of consistently high volatility and continuing concern among investors. Having already completed the first 10 months for the year, we have seen a series of negative records among different asset classes that normally have negative correlations. So this high correlation had the effect of eliminating the concept of a defense in a typical portfolio. This webinar will not analyze what caused this current market drawdown and will not provide you a market update. Instead, this webinar aims to provide you with charts and historical data that this market drawdown is not different than previous ones. And after a market decline, always, new highs will follow. We understand that for many investors, this year is very painful, but history suggests that markets provide positive long-term results with positive annual returns of over 75% annually. Demetris and Kirill have excellent data to prove it, and will try to answer some common questions that investors are asking us and are typical questions during drawdown. Kirill.
Yes, Dimitris, thank you very much for your introduction. A few words about me. I have over 20 years experience in the financial markets as a trader, as a structurer. A few months ago, I have joined Export Wealth as a senior private wealth manager. So today, we try to be quite brief and provide you with interesting data. I truly believe that 8 slides that we're gonna show you today gonna give you a very interesting perspective on the markets overall. There's a very quality data being compiled by our portfolio analysts. So let's begin with slide number 1. Yes. Great. No, that's a different one. If you go to S&P 500 annual returns, please. The first one, sorry, the stocks, bonds, and bills. Yeah. So this is data provided by Morningstar. Over 96 years. So, for example, if your granddad or grandmother has invested $1 back in early 20s, so you can see the immense profits and the results that could have been delivered today. Even if the 1929 crash happens, minus 80%, I think, more or less, the investors saw back then. Next 10, 12 years, 20 years, you would have made 10 times, 20 times over your investment. So what does it tell us? That a long-term investment in stocks outperform any other investments. It could be government bonds, treasury bills, could be property prices as well. I can assure you that stocks outperform those investments long-term. Here, small stocks, we're referring to small capitalization stocks. It's just definition for me, just in case to refresh the knowledge. It's up to $2 billion in capitalization, but they're quite risky investments. So we would focus on large stocks that quite big, say 10, 20, 30 billion plus capitalization. So up to 1960s, 70s, the small cap stocks and large cap stocks were almost identical. Then the slight difference in yield and compounding interest took off. That's why you see such a huge interest over the next 50 years difference in returns. But still, any dollar invested almost 100 years ago would give you roughly up to 5.4 thousand times the original investments. That's colossal return. Yeah, so that's a brief sort of overview of a long-term view of that proves the historically stocks outperform any other investments. And then let me introduce you Dimitris Theophanides. He's my colleague. He's a senior private wealth manager. Has extensive knowledge in private banking, financial markets. So Dimitris, please take over from there to slide 2, please. Thank you.
Thank you, Kirill. Thank you for the introduction. I'm Dimitris Theophanides, as Kirill said. I joined the Export Wealth a few months ago after an extensive career in the banking and financial industry in Cyprus and the United States. Now we're going to see the first slice with the S&P 500 annual return from 2002 to 2022. It was over a period of 20 years. S&P 500 basically is an index consisting of about 500 large capitalization companies, including companies such as Apple, Microsoft, Amazon, Alphabet, and other well-known names. On this graph, the first thing that stands out is that for a period of about 20 years, we see that the downturn occurred only in 4 years. And the biggest downturn, which you can see with the blue on 2008, occurred 2008, and it was minus about 38%. This year, of course, we also had a downturn, but it's not as close as previous years. And if you consider the whole 20 years span of the markets, we can see that it's not a common thing for the year to end in a downturn. Other interesting things we can notice here is that if somebody, for example, in 2008, when the market was down minus 38%, got out of the market, it would really miss 9 years of excellent annual returns. As you can see here, for 9 consecutive years, the markets ended in considerable profits, basically. So it pays to stay in the market. It's not good to rush and get out of the market with the first downturn. And the statistics don't lie. So we can see over a 20 years span, the people who had the patience to stay in the market make considerable profits. Even years that they were considered bad, like 2020, when the COVID-19 really started to close down business and people stayed home, we can see that even that year we had a positive return. Of course, we can see in more slides, when we continue, what happens in the bigger spans and in different situations. I think just to summarize up on these slides, we can see that if you annualize the returns for 3 years, it's about the return of 10.16%. For 5 year span, annualized returns are 10.37, and for 10 years, 12.68. Now, for the full 20 years, we can see that we have a return of about 8.05. Which is considerable, and this can translate for doubling your money every 10 years. This year, of course, the market is down around 14% roughly, but consider that at some point the market was down 24%. So it's not a good idea to rush and get out of the market when you see a downturn.
Also, Dimitri, I would like to add also that the full return of 8% annually achieved with the first year with a minus 20. So if an investor was starting to invest in 2002, his first year would be negative minus 20% and similar to what's happening this year.
Yes, that is correct. We see that somebody we started to calculate here from 2002 that the market goes down. So if somebody went to a down market, you still make considerable returns, as Demetris is saying. I think we can continue with this next
Yes.
slides unless Kirill has something to add.
Yes. No, let's continue. We don't want to get too long
Okay.
to get people bored. Yeah. So please next. Yeah. In this slide, we can see the stock market losses from 1928 to 2021. So you can also consider, or metaphorically maybe, stock market as a breathing animal, a breathing bull. It's when it breathes up, it goes up. It breathes out, it comes down. So it's never a straight line. So any investor should be acceptive of potential volatility. And as you can see from the graph, 5% declines are almost real every year. So the portfolio might fluctuate 5%. It's yearly. It's normal. 10% also quite often. So what we had this year in 2020, 20% or more, it happens only every fourth year. And the massive collapses and the big sell-offs happen, say 5 years out of hundreds, so even less. So things do happen, but negative things do happen to the financial markets, but they're very rare, and the results are always, as history shows, always positive. So again, the investor should be patient, should be looking to long-term perspective. If you're looking to invest for somewhere for 1 year, obviously stocks might not be the best option. If you're looking, I'll say we recommend 5 to 7 years on average to start with, to see the results. So and these statistics show exactly that anything can happen, but wars, crises, epidemic situation can get worse, etc. But human psychology is very optimistic overall, and very constructive in a way. It wants to create things, it wants to grow, and the profits, to grow the economy, to grow the profits. So the money cannot be idle for long. So now we have lots of sort of cash available for hedge funds, for big investors. They're all waiting to invest, and that's what we see in 2020. The market collapsed in 1 month, and it was bought out immediately, because people saw it's a huge opportunity, and they made a lot of money when you buy a falling market. So that's it for this slide. Let's move to the next one.
Yes, thank you, Kirill. This is another excellent graph that shows the S&P 500 intra-year declines and calendar year returns. In a sense, what we can observe from here is how much the market went up in a certain year. So we can see with the blue bars the closing of each and every year from 1980 till 2022. Of course, 2022 is not over yet, so we don't know the final closing mark. What's interesting with this is that we can observe easily that most of the years the markets finish up in a span of 42 years. Another interesting thing that we can observe is that despite the fact that the market most of the time closes up, there is huge volatility. So we can see certain years the market going really down, and it's very large percentage, and then ending up. And I think 2020, if you can look at 2020, you can see the mark of -34. So at some point in 2020, the market was down -34, and then it ended up the year with +16%. And this was the year of the COVID, that, when the business started closing and people stayed home and the unemployment was high. So we can see that even when everything seems to end, and like the world is going to end, or a huge event can be magnified with media, that things can change and eventually the markets can recover. So if you can see more closely, if somebody had left the market in -34, you will lose the opportunity of gaining 60%, some plus 27%. So that's huge if you think about it, because then the investors wouldn't have the opportunity to recover and get their money back. They will live with a loss, basically. Some other interesting facts is that, let's see, in 42 years, we see the intra declines, but eventually, most of the time, the markets closed up. Of course, I'm not saying for somebody to go and expect 34% or 30% down occur in some years, but this signals that eventually the markets are going to recover when we have downturns, and the people who have enough patience, they can make good money for their retirement or for their kids' college education, etc. I think about it, this sums up. I don't know if Dimitris or Kirill want to add anything, or we can move to the next slide.
Yeah, we can move. Next slide. Thank you. This is a very great piece of information, I would say. It's very representative of visually, what's been going on with the historically with the markets. So bull markets are marked in blue color, and the bear markets are marked in sharp, small pinkish colors. So as you can see, the majority of the time, the markets are in bullish territory. The market drawdowns, market falls occur regularly, but after that, the period of bull runs are usually quite substantial. So the same conclusion from as for the previous slides, that human psychology affects the investors, and they will invest money to make more profits, more money, and any drawdowns, any big falls historically sees, and the new bull markets emerge. So the data here is from 1966 until 2022, almost roughly 50-60 years. And again, you can see that the drops are usually really sharp, really intense. The reason for that is that many investors, when they get greedy over big bull runs, they use leverage. They borrow money against their portfolios, buying more shares, using more debt, and at some point, that could inflict some serious damage to their portfolios. We don't advocate leverage. Here at Export Wealth, we only use non-leveraged products. So therefore, when the market is falling, they have to close out the margin calls, the short positions the long positions very fast, and that's why they need to sell. That's why the drops, usually sharp drops, take 1 year or year and a half, and the intense drops usually take a month or 2 or 3. That's when the whole the maximum panic occurs, and that's the perfect time from our perspective to buy in when there's blood on the street, when the people are selling and thinking it's the end. Like if you look at the like 2008 crisis, I was on the dealing desk when people saying that's it, the bank's gonna collapse, the world economy is ruined, capitalism is ruined, and look what happened. The government stepped in, they supported the banks. Of course, some might argue that long-term effects are still unknown, but the fact is that they managed to save the economy and save our normal way of living by injecting and supporting the big institutions. So I think that the governments around the world managed to do it really nice in 2008. I mean, we'll see how it goes further, but I'm sure that any big drops will be bought out by the investors. The smart money that always has extra cash, that waiting and sitting to buy some value stocks. I'm not talking about Warren Buffett only, but I'm talking about big hedge funds that can hold quite a lot of cash to snap those big good names, I would say, that are sold off and oversold from their perspective. So yeah, Dimitris and Dimitris, do you have any comments? Any I think you would like to add to this slide?
One thing that is very interesting, Kirill, is the big bear market of 33 days that occurred during the COVID period, I think.
Yes.
I think it's something that never occurred before in such a short period of time. And then we see again positive returns, in a time that everything was closed and people had nothing positive to say.
Yeah.
So this should be like a lesson for the investors to stay in the market and look for the long-term picture.
Exactly. Even in late 80s, when there was a sharp drop, I think over 20% within a few days, the market been bought up, and people actually who got in. I mean, it's quite scary, to be honest, to jump in when everybody's selling. But history shows, the data shows that it pays off in the long term, especially. So if you buy a very quality stocks that you believe in them, or you know something about them, you think like that they are good value, you hold them and you just keep in your portfolio for many years, and it will pay off in the long run, definitely. Short term, the big volatility can happen. This is a bit of a Warren Buffett psychology and strategy, but he's top 5, top 10 richest person in the world, because he uses that sort of investment approach. So he buys value and holds it. So let's probably if any of our guests have any questions, we would answer them at the end of the our webinar. So I guess we'll try to be not too long in our discussions, and let's move to the next slide. Dimitris, thank you.
Okay, let's look at this slide right now. Basically, it shows what happens after a large drop of the market. We can see what happens after a 10% market decline, a 20% market decline, and 30% market decline. Usually a 30% market decline is considered to be a correction, while a 20% decline considered a bear market, and a 30% considered a crash. But the interesting thing is that even with 10% decline in the market, immediately after 1 year, the markets had on average 12.5 return. On a 3-year period, even bigger returns, 34.5, and over a 5-year span, we see a 68.8% return. Now, for even bigger decline, for 20% market decline, we see within a year to have a return of 22.2, 3 years 41.1, and 5 years 71.8. By the way, the 5 years is usually what we recommend for somebody to hold the stocks, in a sense that the markets are usually volatile. So somebody who wants to get out of the market in 2, 3, 4 months may not be suitable for him to go into equities and choose some other kind of assets to invest. Now for a 30% market decline, we can see that within the year we had 23.8. Within 3 years span, we had 16.4 on average return. And then after 5 years, average cumulative return was 50.1%. So we can see what happens, if somebody is patient and stay in the market when we have a decline. Unfortunately, a lot of people get scared, they get afraid, which is normal. And unfortunately, some of them are rushing to get out of their positions, and they miss the opportunity to gain big returns for the years that follows. So it's something to consider, and it's something I think that we have seen over and over and proof in the previous slides as well. I think Kirill, we can continue with the next slide.
Yes, thank you, Dimitris. Okay, the next slide is how do stocks perform around recessions. So first of all, everybody's talking recession. I would like to refresh what's the meaning of this word. Its definition of it is 2 consecutive quarters of negative GDP combined with high unemployment, typically with high unemployment. So, and as you can see, the table might seem a bit complicated, but I'll try to make it easier. So on the left, we see recession starts. It's the date of the recessions and the length. typically the recession would go up to 1 year, year and a half. So no matter how bad the economic situation, the economy recovers. Yeah, that's wonderful news. So historically, it's 1.5 years. It's been 2007, 2008 was a very sort of big crisis, and still we recovered from it. So also another point from this table is that the majority of the fall or any sharp drop in markets happens before the recession, because markets always uh, faster than the real economy. They react faster. They see the potential troubles, and the big fund managers, by seeing the looming recession, starts to unwind their positions, or to the big investors start to closing their positions. That's why we see often like 6 to 12 months before the actual data that came in proving that there is a recession, uh, um, uh, the stocks drop before that. And during the recession, it's typically 1%, so it's quite insignificant. So the whole everything happens before in terms of stock prices. And then you see further 6, 12 months and 2 years, the results I think are phenomenal, like 7, 16, 20% on average. So all you need to do, I mean, according to statistics and to this data, you just need to buy during this recession times, and there's an average return of 20% could be achieved easily as per past data. Of course, it's not guarantee of the future results. You never know what's going to happen next day, but as long as human society is alive, I think the stock market would provide the unique opportunities for investments to reach your goals in, like, I don't know, buying deposit for a property or children education, as Dimitris said, or anything like this, with a period of investment horizon period of maybe 5, 7, 10 years, 15 years, even better. So that's I think it for this slide. And you can see also the end, this positive returns period. So it's statistics is quite positive after the recession, 6, 12, and 2 years after recession. So it's a good sort of data field to understand what's so terrible what recession is, and how the stock markets behave when they face recession, and what's happening after that. That's it's quite, I think, quite useful set of data to understand, not to be scared by this word recession, economic downturns, etc. So any comments from you guys? You want something to add?
Well, I think something that is interesting, Kirill, is that we can see that recession can span about 6 months, but bear markets, like a drop of 20% or more, can occur over a few days. So
Yes.
It doesn't necessarily mean that recession correlates with the drop of the market and vice versa.
Exactly,
There's
yeah.
two separate things, and investors shouldn't be so scared when they hear the word recession, because by the time that recession hits, and big upwards may continue. So it's not something to consider and prevent you from investing in the market.
Yes, by the time recession hits, the prices are quite often reflected already in the stocks.
That's correct.
Yeah, I agree with you. Yeah. So let's move to the I think final slide we have today. So trying to be short.
This is the
not
final
to-
one.
yeah.
Yes. I think this is a very interesting graph that we see here, because we can see what happens in the market for investors who are rushing to get out, like in a year or 5 year even, what opportunities they can miss. On the first graph, we can see that 73% of the times of the years we have positive returns in the market for a period of 1926 to 2019. So most of the time, the investors can have a positive return. Now, if we annualize this on the 5 year returns, we can see that the markets go down only about 13%. So somebody in probabilities has probability to lose money only 13% of the time if they invest for a 5-year span. Now, if we extend the time frame now to 15 years, we can see that there is no possibility at all, like at least from historical perspective, for somebody to lose money if they invest their money for at least 15 years. And this is huge because a lot of people are saying that, they don't want to invest in equities because they're very risky. Yes, but I agree, they're very risky and very volatile in the short term. But if you keep the equity in the longer term and even for 10, 20 years, then you can see that your returns are going to be positive for sure. Somebody may ask, what the percentage they can get during this time period. And we just saw in the previous slides that you can get, like in a 20-year span, around 8.05%. And of course, this is the average in the market. We don't know what's going to happen in the future, but if history teaches something, is that things may continue the way they happen, like for the past 100 years.
Yes, and also I wanted to add quickly that investors investing in long-term in equities, in the quality names, they could get dividends, and it's obviously it's reinvested. But I'm saying that there is a cash flow, not less than fixed income and bonds, but still you get some income from your portfolio, and then it's up to you to decide whether you reinvest it in your stocks or you take it out and spend it. So there is a big advantage of dividend stocks in your portfolio as well.
That's correct. I think at this point we can summarize a little bit.
Okay.
Over and say a couple of things about the overall presentation.
The last graph that Dimitris presented was very important because it seems that the volatility and drawdowns are part of the investment process, but stock markets produce positive returns of over 75 to 80% annually and up to 100% in 50-year horizon. So long-term investors will always be awarded for their patience. So to sum up, what an investor should do, I think the steps are very simple. First, to stay calm. Do not be emotional with their investments and do not overreact to market news. To follow their investment plan. Stay invested, accept the market volatility, and stick to their long-term plan. It's very important. Also, if they have some additional funds to contribute with a long-term horizon, maybe now it's the best opportunity. And also to speak with a professional investment advisor or a trusted portfolio manager. It's very important during these difficult times. Also, for more reports and articles from our investment team, you can visit our knowledge part of our site and find some very difficult, some very interesting articles. Dimitri, Kirill, if you don't have anything more to add, we may go and see some questions.
Yes.
Yeah, I think we can go. Yes.
Yeah, there is one question coming in about the what's your opinion for income strategy investments during turbulent market environment? Do you follow relative strategies in your portfolio? So for the first part, if I may answer, you guys can add also your opinions. It all depends. Turbulent market environment. Is it the hawkish? I mean, no, dovish. The interest rates are going up or going down. So obviously for income strategy investments, they would have big chunk in bonds, yeah, and bonds could be affected by the obviously by the interest rates. So if there's not much changes in the interest rate environment is not changing much, yeah, it's a good idea. But now, for example, we had a big rise in U.S. interest rates. The futures point that they will cap in March at 5%. So the markets, again, according to Bloomberg, the markets predict that it's going to be another interest rate rise in January, and then Fed will pause. I mean, there are lots of opinions what's going to happen. We don't have a kind of advice as to how Fed would behave, but yeah, I mean, if you have to look at the interest rates policies and where you see your investments in regards to the fixed income. Again, the some investment plans might have huge portfolio of bonds that they rotate them often, or like maybe some big funds rotate them on a regular basis, and they try to chase the yield. In this case, yeah, it's not going to be subject to big losses. But yeah, again, you have to be careful. Overall, I think now potentially, yeah, for investors, if they look at the Bloomberg sort of reviews in terms of future interest rate rises, they could make some decisions based on that. However, yeah, you have to be understand what's going on in interest rate market. In regards to the second part, yes, of course, we have lots of strategies that the relative based, so they outperform the indices, and our portfolio managers are doing a great job. Only about 20-25% of managers worldwide they outperform the indices. So it's not as S&P type following strategies. It's more like separate indices that are available on our website. There's a comparison to the relevant indices, and most of the cases we outperform significantly or slightly outperform the indices. So I hope I've answered those two questions. You guys, anything have to add?
Not to be more specific, yes, we do have strategies with income. We do have 2 plans based on income, and are becoming more popular due to the market conditions the last year, high inflation, so many investors are looking for some income.
One other thing that we can say about the income-producing assets is that in times that there is volatility and the markets are down, if somebody gets a decent return, either from dividends, either from coupons, they can minimize their losses and may even beat the market in a sense, and the benchmarks, because they get decent returns back, which they can reinvest in a later time. So that's also important, and it's an option that we give at Export Wealth with our plans. Investors can either reinvest their dividends and their coupons, or take them and use them for their own personal use. I don't see any other questions at the moment. I don't know if anybody wants to add any comments or anything else. Okay, I guess.
So we managed to do it in less than an hour. So it's a good effort from our team, and we don't get our visitors, guests get too bored with too much data, I think. So overall, we try to be quite short and punchy.
Just a final comment, question that I had from a customer a few days ago. He was asking me, is it a good idea to stay off the market now and not get in when I see the market to be like 10, 15, 20% down and wait for more? In general, I will answer that that's not a good idea, because most of the time, the best days are right after a big drop of the market. So statistically, not going to benefit him anything in terms of their returns. It's better to stay investment in the long term, and that will bring more benefits to their portfolio than trying to time the market, in a sense, to try to see when the market is going to go up or down. Because the truth is, nobody knows exactly when the market is going to go down or up. But if you follow a long-term strategy, as we all demonstrated today, then you're going to be a winner, in a sense that you're going to get better returns than trying to get in the market at certain specific times. Here, we're not doing day trading. It's more of a long-term strategies because I think that investors can benefit more by having a passive investments for the long term rather than trying to beat the market by buying and selling specific securities. And that's another issue with the specific securities because you have company-specific risks, but buying exchange-traded funds or read the index, you eliminate completely the company-specific risk, and you can have better returns in the long run.
Totally agree with you, Dimitris.
Okay, I think we have no other questions. So we would like to thank you for being with us. Thank you also, Demetris and Kirill.
Thank you
for the presentations, and we hope to see you soon in our next webinar.
Excellent. Thank you.
Thank you very much for watching.
Thank you.
Thank you.